Welcome everyone to another Maine SBDC webinar. My name is Kelsey Reardon and I am with the state office hosted through USM. And we are joined today by Maine SBDC Maine SBDC at CEI Business Advisor, Raynor Large. So we're going to be going over when to hold them and when to fold them. So it's an important aspect of owning your business is knowing where you stand at all times, if possible. And so this will help you to kind of assess where you're at or assess what to assess, more likely. And we will be recording today's session. So if you want to just sit back and listen, you'll be able to rewind that recording and go back to double check anything needed later. I'll also be sending out the slides, so keep an eye out for a follow-up email from me later on that'll include all of those resources, as well as our contact information. So if you are not familiar, we are the Maine Small Business Development Centers, and we are here to help with just about anything your small business could need. And if we can't answer your questions, we can find someone who can. We can't provide legal or accounting advice necessarily, but we can connect you with people who can, and we can fill in the gaps along the way. So all of our advising is no cost, confidential, and there'll be an easy link to sign up for that in my email. If you have any questions today, plug them into the chat below, and if we don't answer them along the way, there'll be time at the end. If you have a question that comes up later, feel free to respond to any of my emails and I can probably connect you with Raynor to answer the question because I'm not sure that I could answer any of these questions. But I'm excited to help. So please feel free to introduce yourself in the chat along the way. Maybe let us know where in the state you are or what kind of business you have. And otherwise, I think we're ready to get started, so I'll pass it over to Raynor.
Perfect. Thanks, Kelsey. And like Kelsey mentioned, the SBDC is really the majority of our work is done one-on-one. So that's kind of our sweet spot, and that's what we like to do. As much fun as these webinars are, if you do have specific questions and you want to do a deeper dive, please reach out. Happy to do that. Like Kelsey also mentioned, I'm not an attorney. That's always the first disclaimer for something like this. If you're considering bankruptcy or using that kind of form of legal protection to protect your business, please consult with an attorney sooner rather than later. There are some specific things you can do to either prepare for that process or things you should avoid doing if you're thinking about taking that step. So doing that sooner rather than later will help you kind of understand those guidelines in a way that is most important to your business. That said, today's a small group. I know Kelsey mentioned using the chat, but because it's a small group, I would much rather just have kind of a conversation. So if you have a question, just take yourself off mute. Feel free to interrupt me. I'm sure I'll cover topics that, other people have questions on. So if you're not asking the question, someone else might have that question and not be able to ask it. So interrupt me. Let's have that conversation and we can make this as pertinent to your business and your struggles as possible. A bit about myself and why this is a topic that I really enjoy talking about, I think is important. When I graduated, my first job was actually as a receptionist for a small tech firm that was real estate adjacent, right when the housing market crashed. So we went from around 140 employees to about 70. And I worked there for 4 or 5 years. And in that time, I went from the receptionist to billing coordinator. I was in the marketing department. I did human resources. So I really got to kind of see what a true turnaround situation looked like. In that time, we did some mergers and acquisitions. We expanded. We ended, by the time I left, we had about 150 employees and we were more profitable than we'd ever been. So it was a really cool time for me as, a young, kid, really just out of college to kind of explore that and be part of that experience. At that time, I moved to Maine and got a job with a firm that just did turnaround management. So we were brought in with small companies that were struggling and we worked as fractional CFOs, so purely in a financial projection sense, and worked through that turnaround management or orderly liquidation and the negotiation process for that. So that was really interesting and emotionally difficult time, but rewarding in a lot of ways. Along the way, I've also done a fair amount of business brokerage. I'm credentialed to do business valuations and opinions of value, and then started having kids and wanted to have a more balanced work-life balance. And the opportunity presented itself to come on board as an SBDC business advisor. And I've loved it and haven't looked back since. So, I want to start out by kind of delineating this idea of a breaking point, right? So there's two things that we can talk about with a breaking point. One is your breaking point as a business owner, and that is what time you have available, the money in your bank, your personal risk assessment, age, health factors, stress factors, your spouse, whether or not they're on board or pressuring you to take more time for yourself, and available energy. And all of those things are so unique to you that I won't really be able to cover them today. And I don't have the background, unfortunately, to be able to provide much insight to that. That's a very personal decision. What I'm going to be focusing on is the business breaking point, the idea of this, do you have cash available to meet your obligations? And how do you look forward, look ahead to make sure that that will continue and that you're moving in the right direction? And how can you do so confidently, right? How do you make that decision now that you're moving in the right direction and can continue to do so in the driver's seat of your business? And that's the fun part for me, because we can predict it, right? And we predict it using the financial model. So two reasons the financials are important. One is internal, right? This idea that with the financial model and projections, you're really doing an apples to apples comparison of every decision you make as a business owner. Everything that you do has a cost and an intended outcome, right? You invest in advertising and you hope for an increase in revenue. You hire another employee and you hope for increased productivity, right? It's this idea of, do I buy equipment? Do I add a second location? Do I, downsize? Do I change this or that about my business? All of those things can be boiled down to that financial impact, right? The goal, the outcome on the bottom line, and the cost upfront of doing that thing. And by understanding that, now we can compare those decisions. Now you can say, okay, is it better to do A or B? The second reason these financials are so important that I really harp on and lean on is external, right? It's this idea that the financials are the language of professionals. So if you want to bring in your accountant and say, hey, I had a big tax burden last year, how do I reduce my taxes this year? You have to understand the financials and how you pay taxes based on your financial performance. If you want to bring your business to market and work with a broker and say, hey, I've created goodwill value that's intangible, it's my reputation, you have to be able to speak about the financials, how that translates to the bottom line, how you're converting that goodwill to revenue, right? If you're talking about bankruptcy with an attorney and you're saying, geez, I really don't know if I can continue to service my debt at this level, you have to be able to understand the financials. All of this is right there in the financial sense. And that communication is the translation of your intuition, your intuitive knowledge of your business to the language they're used to speaking, right? So kind of high level, what are the financial statements? Why do we bother with this distinction? So there's three financial statements, and we'll talk about each one. Where you're most comfortable and where you spend 95% of your time is that top one, the income statement, profit and loss, right? And that's over a period of time, and it's simply your operating performance. So most of your day-to-day activity is right there. It's saying, how well are you using your assets to generate cash and cover the operating costs for that period of time, month or a year, week by week, if you're looking, that closely. So what is your business doing? The second financial statement is the balance sheet, right? And that is what is your business. That has actually very little to do with your operating performance. It's just looking at your assets, your liabilities, and your equity. That's at a specific point in time. It's saying, okay, today at noon, what are my assets, my cash, my inventory, my furniture and fixtures? What liabilities do I have? What is my outstanding debt or my credit cards or my vendors that I haven't paid yet? And the difference between those two, what is my equity? What equity have I created? My assets are more than my liabilities. Great, I have positive equity. My assets are less than my liabilities. I'm a little underwater here. I need to continue to use my assets to generate revenue. Now, the cash flow is probably the most common thing that you look at because that's the combination of the two, right? There's nothing new in the cash flow statement. It's just reiterating that information in a way that reflects your bank account, which is ultimately, your goal. So one question that we come across a lot is why, right? Why do we distinguish between these things? Why can't we just look at our bank account and say, okay, I've got cash, this is good, or I'm bouncing checks, this is bad? Two reasons, right? So the first reason, simplest reason, the IRS charges you taxes based on your income statement, right? They don't care about your balance sheet transactions. They don't care about what equipment you're going out and buying. They care about your operating performance. So purely based on accounting, the way you have to file your taxes, they're interested in your operating performance. And so understanding that distinction allows, you and your accountant to kind of maybe play with that a little bit and reduce your tax burden. Do that in November and December. It's a little late by January or February. The second reason that distinction, that separation out of these financial statements is important is because from an internal perspective, you're talking about comparing period to period or understanding, that are you getting the impact that you want from a decision you've made by separating out balance sheet transactions, reinvesting in your business and non-operational expenses, then you can compare, right? So that operating performance allows you to compare period to period how well you're doing. And that's really critical, right? If you start incorporating non-operational expenses into that operating statement, it hides what you're actually doing. It hides your performance. And it becomes harder to say, okay, am I doing better this period than I expected? Am I doing better this period than I was last year at this time? So again, internal, external, right? External, the IRS requires you to do it, so you may as well. Internal, once you separate it out, then you kind of have a better idea of how can I use this knowledge to make sure I'm moving in the right direction. So kind of dig in a little bit more. Like I said, the income statement is where you spend the majority of your time. And there's really three parts to the income statement. You've got your revenue, right? Your sales in that time period. And then your expenses are two parts, right? Your cost of goods are the expenses associated with the sales. If I've got a restaurant, I want to track my ingredients as a separate line item, my direct labor as a separate line item, because those things should go up as my sales go up, and they should come back down as my sales go down. Right? So I'm looking at my cost of goods usually as a percent of my revenue. I'm saying, okay, every dollar I make, how many cents goes out the door to pay for the ingredients, to pay for the materials, to pay for the direct labor? Because if I go from $200,000 in sales to $400,000 in sales, it doesn't make sense to look at and say, okay, my cost of goods was $100,000 and now it's $150,000. That's not, that's not good. It's going up. Yeah, it's going up, but it's actually as a percent of my revenue going down. So I'm being more efficient. I have more value add, right? So that cost of goods we track as a percent of revenue. And we want that separated out so we can watch that go up and down with our sales. The second kind of category of expenses that we look at on our income statement is fixed. It's our overhead, right? Rent, utilities, insurance, accounting and bookkeeping. Those are what they are. And that it doesn't matter if I have no sales that month, I still have to pay rent. It doesn't matter if I have no sales that month, I still have to pay for my insurance, right? So that's set. And then that little bottom piece, that's what I get to keep at the end of the day, right? That's my net income. It looks like this, right? So I can say, okay, all my revenue comes in, and if 50 cents of every dollar goes out the door, then I have 50 cents of every dollar to cover my overhead. And I can easily say, okay, if I have 50 cents of every dollar to cover my overhead and I have $150,000 in overhead, then I have to sell $300,000 to cover my costs, right? $300,000, 50 cents goes to ingredients and direct labor, 50 cents goes to cover my overhead. So that's just like a very simple break-even analysis to say, okay, am I winning or losing? Can I cover the costs of my operations? And ultimately, what we're talking about as a business and looking forward and trying to figure out if that little blue piece is worth it, these are your goals, right? Can you sell more green? Can you sell enough product in a time period to cover the cost of creation of that product and your overhead and have that little blue piece left? Now, that little blue piece, right? I talk about the balance sheet, how the balance sheet's broken down, and we use that little blue piece to reinvest in your business, right? So balance sheet, just to kind of look at it again, assets, liabilities, and equity. And you can kind of think about it like a house, right? So if my asset is my house and my house is worth, I don't know, $400,000, and I have a $300,000 mortgage on the house, right? Then my equity is the difference between those two. I have $100,000 in home equity, right? So that's the balance part of the balance sheet, is that my asset, everything that I've created in an asset is either accounted for by a liability, I've borrowed to get it, or I have it in equity. And so as my liabilities go down, my equity goes up. And as my liabilities increase, my equity goes down. Now, if I look at my income statement, I say, okay, well, what's the flow between these two things? I use my income statement to fund my balance sheet. And I can only do three things, right? I can go out and buy more assets, I can pay down my liabilities, or, the dream, I take it all as equity, right? So if I don't have any liabilities, I just convert that cash to equity and I walk away a little happier than I was yesterday. And the cash flow, this third financial statement, in some ways is the least important because it doesn't say anything new, right? This is all information that I've looked at the last two financial statements. And in some ways is the most important because of these bottom three lines. So the bottom three lines are the net cash flow, which basically just says, okay, what was the change in cash for this time period, January or whatever month you're looking at. And then starting cash. So on January 1st, 12:01 a.m., in this model, I have $20,311, and ending cash. At the end of the month, I had $16,882. And what you'll notice is that ending cash position becomes the starting cash position for the next month, right? So that is a rolling cash flow. So I can look at this very quickly once I put together projections and identify two things, right, that are critical in this whole conversation of like, am I going in the right direction? Does this make sense? Is all my work, worth it? And the two things that I want to look at when I look at this are, one, do I ever dip below zero, right? Do I ever go negative? Because the more leeway that I have before that happens, the more things I can do to change that outcome. When am I going to start bouncing checks? And the second thing is, do I end the year with more money than I started, right? So if it's a 12-month period, then I'm taking into account all of my seasonality, the ebb and flow of my season. I'm talking about December 31st, 11:59 p.m., and then January 1st, 12:01 a.m., right? And so it's a full calendar year. And I'm hoping that I end the year with more money than I started. And if not, how much leeway do I have before I run out of cash? In this model, yes, I never dip below zero, but I end with about $5,000 less than I started. So I've really only got 2 more years doing what I'm doing before I start bouncing checks. And that's good in that I know in advance, right? By the time you bounce checks, it's too late to do a lot of things. And the more foresight we have, the more we can look ahead rather than looking back, the easier it is to change the outcome. So, and one of the things I kind of gloss over, but a lot goes into this, is projections, right? So the whole point of this conversation, the whole way that, we navigated through bankruptcy and negotiated debt and everything that I used to do with that company, is you have to look forward. You have to be able to take your historic performance or your expectations and lay that out. And a lot goes into that. And you can work with your bookkeeper, you can work with your accountant, you can work with an SBDC advisor. I'm doing a 5-part series in June that's all about projections, pulling information from QuickBooks and laying that out. So if that's of interest to you, if you need some help to do that, please check it out. I'd love to have you. And for me, it's a lot of fun because it's one of the few ways that you can kind of lift your head up and look ahead rather than just checking your bank balance, which by definition is reactive. Like, that's looking back. That's everything you've done leads to that bank balance. It has no indication of what lies ahead. So, some just kind of rules of thumb about using projections. It's not easy to put projections together, and you're not going to get it right the first time, right? So don't put projections together and check them 1 month and then be like, all right, that was way off. I don't know what I'm doing. I'm not going to do this again. Even, the best CFOs I've worked with, and in a court of law, they would ask for 90 days to have 3 months in a row to kind of work those projections out. So it takes time, it takes effort to go through and say, okay, where am I missing? Where am I, understanding my own business? It's a different language, right? You understand the operations, you do it very well. In some ways, it's exactly that information. And in other ways, it looks entirely different. It feels entirely different. So give yourself time to practice that. Don't hold yourself to this unreasonable standard of I'm going to get it right and be, plus or minus 5% in month 1. So once you have that projection, right, you can look ahead and you can say, okay, does this work? Right? If you look at your cash flow projection, are you increased? Do you end the year with more cash than you started? And do you ever dip below 0? Does this make sense to be moving in the same direction you've been moving? So when to hold them, right? Do you have a good business? Are you moving in the direction you want? You should have projections that lead to positive net income, that have a strong bottom line. And that net income has to be strong enough to do 3 things. And we look at the balance sheet again, and we say, okay, is that bottom enough to pay down your liabilities? First and foremost, right? That's what the bank wants to know. That's what that heavy burden on your back is looking at. Can you support your own debt? The second thing that net income has to do is replace your equipment, right? Your assets. To say, okay, I have to service my debt. I have to replace my equipment. And third, unfortunately, you're the bottom of this list, right? Is there enough for you? Do you have enough to pay yourself, that equity that you deserve, that you need to justify that emotional component, right? That personal component of, am I at my breaking point? What does that equity need to be to justify the risk that you've taken on and the sleepless nights and the work you've done? So the net income has to be able to support all 3 of those things ultimately. And you need a starting cash position to get you there, right? So if you look at your starting cash, you're like, okay, the direction I'm going in isn't where I want to go. But if I change these things, if I, invest in my advertising and marketing and see a 10% increase in my sales, and I make these adjustments, I can get there, but it takes a couple months for you to dig out of that hole or to change the direction, right? That's not going to be immediate. It takes time to change the direction of the boat you're driving. Do you have enough starting cash that you never dip below 0 and you can pull out? So, the importance of these cash flow projections, so you can look at that. So what if the projections don't work, right? What if you're looking at it and you're like, okay, I'm going to run out of cash. My operating performance isn't there. So it goes back to that income statement, right? This is ultimately the performance of your business. You have to be able to say your operating performance justifies all this risk. And it's these 3 things, right? So you say, okay, I can focus on increasing my sales. If I'm looking at my projections and it doesn't work, how am I driving my sales up? How am I increasing my sales, finding new customers, adding other services, advertising to existing customers? Is it as simple as changing my pricing? Do I just need to increase my prices? Or are my costs too high, right? Are my margins too low? I'm not keeping enough of every dollar I sell. Do I need to shop new vendors? Do I need to change the creation of my product, maybe reduce the quality so I can cut costs a little bit? Do I go from a 10-ounce bag to a 9-ounce bag and have a little bit fewer chips in every bag, right? But, none of those are fun, but what are the options there to control that? The bulk ordering, if I go out and buy a larger quantity, does that reduce my per unit cost? Or, that third piece, how do you control your overhead? If half your workforce has been working from home for the last 2 years, can you renegotiate your lease? Can you reduce your lease space? If you look historically and you see your insurance has gone up 15% every year, is it time to call your insurance company and say, geez, is there something I can do to get this back under control? Let's shop this insurance. Utilities, do you keep the office at 58 degrees instead of 62? It's not ideal, but like where can that be found? If you don't have it, like it's one of those three things. We have to either increase your sales, we have to control your cost of goods, or we have to reduce your overhead. That little blue piece has to be there. So what if your projections work? What if you're saying, okay, the operating performance is there, but my cash flow goes negative. I can turn this boat around, but I need 6 months to do it, and I only have 3 months of cash. What are some options there? So, balance sheet solutions, right? Looking at your assets. Do you have old inventory that you can liquidate? What about, unused equipment? Start looking at those assets and saying, okay, what can I convert from these assets to create cash? Unfortunately, right? It's a short-term solution. Ultimately, your operating performance has to carry your business. If you're not generating revenue on your operating side, you're never going to quite get there. But in the interim, if you're saying, okay, the operating performance can work, I need to make these changes, I need cash, then there's these other options, right? We're looking at short-term solutions to find cash. Change your terms, right? Call your vendors and say, hey, can I have 30-day terms on my inventory, 60-day terms, right? So you're creating cash, right? You're selling inventory before you have to pay for it. Again, not a great solution, but possible. What about your accounts receivable? If you carry accounts receivable, is some of that 60 days out or 90 days out? Can you shorten that? Can you offer an incentive of 3% if they pay within 10 days? So instead of having an average of 30-day AR, you shorten that. You have less cash out before you get paid. Take a look at your debt, right? If you have a lot of credit cards, if you have a lot of high interest debt, is there something you can do to restructure that, to reduce that inventory or the interest payment that you have to make every month? Can you term out your line of credit? Renegotiating debt can be difficult. You never want to, tell your bank that you're struggling, because if they send you to a workout department, it's very hard to be classified as workout and then be brought back into the fold. Once you're in workout, you're pretty much stuck there until you refinance elsewhere. But it's an option, right? I try to focus on those top three things first. But banks understand, especially the last couple of years. And if you can get a period of saying, you go to them with the projections and you say, listen, this works, I'm making these changes, it's having this impact, but I need 3 months of interest only. Or I've got this line of credit, I'd love to term it out instead of paying 8% interest on it or whatever it is. So that's an option as well. Have that conversation if you need to. And lenders are agreeable and they will work with you if you present them with the option, right? So there's something called lender liability, where if I've given you money as a bank and you come to me, I can't give you advice on what to do with that money. because that inhibits my ability to collect what you owe me. Basically, if you declare bankruptcy and you can turn around and say, hey, all I did was follow your advice, I don't have to pay you because your advice got me to bankruptcy, the judge will rule in favor of them. So a lender is very hesitant to say, hey, you should do this, you should try this, let's do this. So by the time you go to the lender, make sure that you have a plan in place, that you're saying, we've made these changes, here's the outcome. To get to the outcome we want, we need this. We need 3 months of interest only. We need to term out this loan. We need a longer term length or refinance this debt. And that gives us the cash flow we need, right? So by bringing them that gives them the opportunity to say yes. But if you go to them and say, hey, I need help, they're not going to offer any of those things because they don't want to cross that threshold of giving advice. And then lastly, when to fold them, right? This idea of, okay, when does it not make sense anymore? When is it time to call that attorney to take a hard look and, maybe take a step back, close down your business? So if you're looking at your projections and you're saying, I can't make the changes necessary to my income statement to get it to profit, right? My vendor costs have just gone out of control. Labor costs continue to rise. I've got multiple competitors in the area, so my pricing is fixed and I can't compete. And I'm sinking, right? I don't have the funding necessary, that little blue piece, that net income, to pay down my liabilities, to replace my used equipment, or to pay myself what I think, what I need to justify this. That's when it's time, right? If you can't look at this and find a way, to positive income, to positive cash, you're going to run out eventually. And it's easier to take that step toward, a timely wind down and to step back and orderly liquidation when you still have some cash than it is when you run out of cash, right? So, looking at this and putting those projections together and making that plan gives you the flexibility to try to make those changes, try to make those improvements, and then check to see if they're working. And if they're not, and you don't have any other option, there's no other plan, that's when it's time, to fold, right? To throw in the towel, because otherwise you're going to end up borrowing to pay debt, and these are the three things that we always saw as worst case scenarios that resulted in bankruptcy, right? And when I say bankruptcy, one thing to kind of keep in mind is that bankruptcy is really a financial transaction in a court of law, right? It's a legal thing, but it's all financial. The financial aspect is the important thing. It's just done through the court of law. So a lot of the negotiation that happens in bankruptcy actually takes place before bankruptcy, right? That idea of what kind of debt can you support? Can you renegotiate? Can you recollateralize or make operational changes? By the time you have to do bankruptcy, you've already done those things and they haven't worked. So doing it before bankruptcy saves your credit score, right? And it hopefully you avoid it, right? That's the bankruptcy is basically saying we did all these things and we still couldn't make it work. And then the creditors went after us, and bankruptcy is protecting us from those creditors. So take a look at this now, right? It's a deep admiration for everybody who's attending this, because it's hard to have that conversation and to look very closely at your business if you're worried about something like this, right? A lot of the clients I used to have, buried their heads in the sand, which is why they ended up in the place they were. So the more leeway you give yourselves, the more foresight you have, the more decisions and options are available to you. So these things are the three things that, avoid at all costs, right? So using credit cards or direct draw loans, right? You get that information in the mail of, here's a check for $10,000. All we're going to do is take $200 out of your account for the next, 10 years or whatever it is. They never do the math for you, but it never works out, right? Borrowing from your 401k. This kind of a legal perspective, but so when you declare bankruptcy, if you're talking about personal bankruptcy, you're allowed to protect very few assets, right? Most of your personal assets get liquidated. I think you can protect like 48,500 in equity in your home. They can't make you homeless. You can protect a couple $1,000s in equity in your primary vehicle. They can't take away the right for you to get to and from a future job. And they can't take away your retirement account, 401k, right? If you take money out of your 401k, if you liquidate your 401k, if you borrow against your 401k and reinvest that in the business and then run out of cash, all of that cash becomes available to bankruptcy. And, again, not giving any legal advice, talk to your attorney if you're thinking about it, but that that takes away that protection if you liquidate a 401k. So maybe make that kind of a last thing that you do. And then not paying quarterly taxes, income taxes, payroll taxes, big danger because you can renegotiate a lot of debt. You can write off credit card debt, you can renegotiate bank debt. The IRS doesn't negotiate. They'll negotiate a payment plan, but you owe 100% of that. So just make sure you're staying on top of that. Bankruptcy or no bankruptcy, you got to pay that, right? That's kind of the first bite of the apple. So 3 warning signs, right? 3 things to avoid. Now, I do include my information. Actually, I don't, but I include our information, and you can find me on the Maine SBDC website. I always like to leave time because I know this is a lot of information, and it can be disheartening, and I'd rather kind of just chat about it or talk about it. But it's all about, it's all about projections. It's looking at your business from a financial standpoint and just saying, hey, what's my bottom line, in my bank account for the next couple of months, next, 3 months, 6 months, a year, and does this make sense to me? Right? Do I have enough money in my bank? Are my operations producing enough to cover those costs, to cover the costs of operations, and have enough to pay down my liabilities, to pay myself for the hard work that you do as a business owner, and to justify all of this ultimately, right? And then why I think projections are so fun. And it sounds silly, but I do think they're so valuable to you, is going back to that second or third slide where it's like everything you do as a business owner has a cost and has an intended outcome. So once you have these projections, it becomes so easy to say, okay, if I add this payroll position and expect a 10% increase in sales, what does that look like? Is the outcome what I want? And then you can say, okay, if my expectation is a 10% increase in sales, but I only get a 5% increase in sales, does this make sense? Where is my risk level? At what point does it no longer make sense? Right? And you can do that now. You don't have to wait for 6 months of having that person on board, and then you're double checking and trying to figure out if it's worthwhile. Figure it out now, right? Say, okay, this is my expectation of them. This is how I will measure it and make sure that they're, meeting my expectation. And if they dip below this point, then, it's no longer worth it, and I have to let them go, right? It takes a lot of that second guessing, that sleepless nights, right? The emotion out of it. It's just numbers. That's why I love it. It is what it is, right? You look at it and you say, okay, this makes sense or it doesn't. And then every decision you have is as simple as that, or it should be, right? So, sorry, I'll get off my soapbox, but any questions, concerns about kind of looking at your business in this format?
And he really does stay up on that soapbox if you'll let him. So utilize that. It's unique to find someone who is so enthusiastic about numbers. And so I deeply encourage you to utilize Raynor as a resource for all of this. I don't see any questions yet, but like you said, feel free to unmute yourself. We are kind of a small group today, and these concepts are complex, certainly. Not the easiest to type out.
And just to re-invite, and I just talked about Kelsey with this right before this meeting, sorry, but I am doing a 5-part series in June just about projections. And it's actually pulling information from your historic QuickBooks or accounting software and going through line by line and showing you how to project forward for your business specifically. So if that task seems daunting, but you want that outcome, again, free webinar. It's a 5-part series, but it'll all be recorded. So if you can't make the specific time, sign up anyway, and you can get access to that. It's fun for me. Yeah. If there are no other questions, have a great afternoon. I'll give you back. Oh, Nick, did you have a question?
Yes, thank you. So I didn't put any comment in the chat. I'm Nick Fusco. I'm the owner of the Lakeshore House Restaurant in Monson, Maine.
Mm-hmm.
And this is my 2nd year in business, having taken the business over from the lady that founded it 16 years ago. And with having a small rural restaurant, and restaurant, it's tough. I mean, the labor problems, cost of food, utilities for a small restaurant, plus would I have to pay employees to keep them when they could go to Dunkin' Donuts or Walmart or something like that and make more money? It's difficult. And I don't know, because I'm new to business. I was practicing medicine for 23 years before doing this. I made a lot of money last summer, which that was only a few months after I bought the place, but I have spent all that money just staying open and supporting my year-round employees and being open enough to support my local community. And last year when we got to the mud season, I took $10,000 out of a brokerage account. Last summer, we got a $30,000 grant from the government for the restaurant recovery fund. And I'm down to about, 15 grand in assets right now. And I'm starting to get afraid that, even with some menu adjusting, and trying to contain costs right now, like I don't know how much of this yo-yo I can do. I mean, over the course of a year, where I make all my money in the summertime and then I spend it just to stay open. And with inflation getting worse and the cost of diesel getting worse, it's tough. And I think I'm on top of things, and thank you for all the concepts you've shared, but knowing that better days are coming for me, and it's very seasonal. I get a nice bump from snowmobilers, but I make most of my money off of vacationers up to Moosehead and the backpackers that come through on the Appalachian Trail. Mm-hmm. Like at some point, I'm afraid that the negative swing come the spring is going to be too much for me to weather. And the bank seems really friendly about like extending equity so that I could borrow against the equity and pay it back in the summertime. Like how do you navigate that in a decision to either sell your business or close it?
Yeah. Restaurants are tough to begin with. I mean, that's a thin margin business. So you're really kind of scraping around the edges. But a lot of businesses in Maine are seasonal, and most banks understand that and have working capital lines, which is that idea of you extend the line in the winter to cover the costs, and then you pay it down theoretically to zero in the summer. And don't pay interest for that time period. Ideally, you can, be your own working capital and just set aside enough in the summer months to carry you through those winter months. And part of those projections would be understanding, okay, what if you close for those months and then have to reinvest in hiring new employees? Is it more cost effective, or do you you lose less by staying open, right? And juggling that with the labor market, what it is, it's probably better to stay open and keep those year-round employees if you can, just because hiring is nigh impossible, right?
Yeah, that's what I've come to.
Yeah, so I respect that decision, certainly. And then, it's all about kind of finding around the edges. Unfortunately, pricing is a big part of that, and understanding, okay, how much pricing can be absorbed by your customers before it's too much and you start losing customers.
And we took a deep dive on that. I don't want to bore anybody that's not in the restaurant industry, but there's a saying about, you want 20 to 30% being the cost of your food that goes into your items that you're selling. And then the money coming in, you want that to be 80 to 70%. And I just don't think with the current economy that model actually works, because we went through our whole menu. We priced out all the food to how much it costs us to put it on the table. And we decided we're good. But I still did a 5 to 10% increase on prices with our new menu that's coming out later this month.
Yeah.
Because even though I'm supposedly, according to the formula that, it's like the golden formula of restaurant, it still doesn't seem to make sense.
Yeah. Do you use the Book of Yields? Have you come across that yet?
No, but like I said, this is my first, or the start of my business.
So you can get that on Amazon. I think it's like 50 or 60 bucks or something. I've got a copy in the office, but it does a industry benchmark for actual production out of every unit. So like a 5-pound bag of potatoes doesn't produce 5 pounds of potato food, right? So it's just a way of kind of analyzing that and analyzing waste. So, if you want to do a real deep dive into plating, that might be a useful tool.
Yeah. Well,
I would also say, you mentioned kind of snowmobilers and tourists. Do you do a lot of takeout, or have you explored like prepackaged meal?
Don't say the prepackaged word.
No,
I mean, not locally sourced and fancy. Like we try not to
Okay.
And there's that, through Cisco, you can buy a meal in a bag and dump it out, heat it up, and it's like, ta-da, here's our, whatever. When you said about the potato thing, the guy that owns the barbecue place here in town, he told me, if you sell 3 potatoes worth of French fries, it should pay for your whole bag. Because I thought our French fry prices were a bit expensive, but then I came back to my restaurant, I did the math, and sure enough, 3 orders of fries pays for the whole bag of potatoes.
Perfect. Yeah.
But
so finding those loss leaders or not loss leaders, but the high profit items, and then making them, giving them kind of priority on your menu, or drawing attention to them in some way, or
anything that has like chicken in it, or steak, or like lobster rolls, for example, like that, those are tight. Because if I tried to apply that, to a lobster roll last summer, I would have been charging $50 for a sandwich on a hot dog bun.
Yeah.
And that was just crazy. And I know I undercut a lot of the local competition by a couple bucks on purpose. To say that a lobster roll was $26 at the Lakeshore House was better than $34 up at the Stress Free Moose in Greenville.
Well,
and I hope
I'm kind of hearing, so 2 things there. You said that you have a lot of focus on like locally sourced ingredients and being high quality. Mm-hmm. If that's the case, you want to be higher priced than your competitors, right? Because there's the insinuation of quality associated with price is part of that psychological play, to just say, yes, we're better quality, but we're cheaper. Okay, why? Right. And then part of it is those things cost you more, right? So if you're paying more for them, competing on price, isn't ideal. Like it's the customer service triangle, right? It's price, quality, or speed. And you can only compete on, 1 or 2 of those things at a time. If your focus is on quality, it could be quality and, cost, but are you slower in the restaurant? It doesn't really work like that. So if you're competing on quality, make that your competitive advantage, and that's your marketing materials, and that's your presentation and your menu and your sign and logo and website are all about quality, right? That's the message. And you hammer that home, and that justifies a higher price. And that's fine, because that's what people expect when they go to your restaurant. So, I'm not, marketing's not really my strong suit, but I know a lot goes into that. And people draw an assumption based on the price a lot faster than anything else. So you can market quality all you want, but if you're priced cheaper, that's the assumption, is that the quality's not there because you're more affordable. Sorry.
Yeah, that's a good point. I just wrote that all down as you said it. So maybe I am hurting myself on ribeyes and lobster rolls.
And so there is that concept as well of the loss leader, where it's like, okay, I'm break even on the ribeye, but I offer a ribeye plate, and I have higher margin on the soda and higher margin on the potatoes or whatever it is. Yeah. Or you buy the ribeye meal and it comes with all these other things, and so yeah, the ribeye is pretty much a break even, but they get these things that are higher profit margin, right? So you're kind of packaging it, and make sure you're doing that, right? You don't want somebody to leave with a full stomach who barely covered their costs.
Yeah, because I mean the ribeye itself, just to put it on a plate for me, is about $7 to $8.
Yeah,
but I'm certainly not charging $40 for a ribeye dinner based on
right. I'd expect to pay $30 or $40 for a ribeye dinner if I go anywhere, right? Or why not, right? Is this a cheap ribeye, right?
What's that?
Or I'm assuming it's a cheap ribeye.
Right? Yeah, understood. Yeah.
Sorry. Just from a consumer perspective.
Yeah.
I don't want a $20 ribeye. If I'm getting a ribeye, give me the $40 ribeye.
Yeah, but where are you living at?
Cumberland. Yeah.
So I mean, here in Monson, it's pretty rural. So I mean, I can sell a $40 ribeye to the people from Massachusetts and downstate, but trying to sell it to my locals that's tough too, because this area is pretty downturned.
Yeah. Could you offer like a high-end ribeye and then a skirt steak meal or some?
I could do that
to kind of hit both demographics. It's hard too, maybe. And sorry, I don't know if people are hopping off the call or not, but happy to dig in. Do you do two menus? Do you have like a winter menu for the local crowd, and then in the summer you gussy it up and have a higher end state menu, right?
With the winter time, it's kind of hard because some of the snowmobilers, those guys are high rollers and hard drinkers.
Okay. Well, so maybe
hard. I remember that I had a lot of ties to Key West, and if you were a local, you kind of there's like a local deal that was kind of like a wink, and it got you free appetizers or free drinks or something like that at a lot of the local restaurants, because most of them were charging a tourist rate, basically, right. Meals and the drinks. So if you showed them your driver's license and you had a Key West or a Key whatever driver's license, there was some perks involved that were kind of off the books and unspoken.
Yeah, and maybe I hate to. This is being recorded, so I can't say too much, but that's between you and your employees, right? If the poorest are a little more generous for those in-state licenses, who's to say?
No, and I will. I mean, I've comped patron stuff here and there just because they're so good to us. So
yeah,
and even at the end of the year, I gave out gift cards to our 3 best patrons.
Yeah, and a big part of that is the communication, right? Yeah. So if you're doing that, then the whole advertising is that word of mouth, nudge and a wink understanding. So make sure that's kind of understood in the local community, because people like that too, right? It's kind of like the old speakeasy model where I know what's going on and that makes me feel special. I'm a premier customer. So
they're out there.
Anything else? And, I'd also invite you, Nick, we do have like marketing specialists. I gave my best shot at it, but we've got some great people in the advising sector. Everything we do as SBDC advisors is 100% confidential. Most of it's not recorded, and not insinuating that we say anything, illegal or anything, but it's confidential and it's free. And so if you have a specific question or a specific need and you want to reach out and speak to someone who has a specialty in that area, like marketing, like financial projections, invite you to just, you can request an advisor and put it right in the notes that that's what you're looking for. And we'll hook you up.
Okay. Yeah, I have like monthly meetings with Allison Lane, so maybe I can bring it up at our next meeting.
Perfect. She's a good one.
She is a good one. And I'll just put another plug in for the financial projection series that Raynor was talking about. In particular, he hits on like how you quantify that seasonal change in your budget. So that might be helpful, Nick, for looking at this coming season, but the whole year as a whole. So I am in the process of publishing that on our website. So that should be live today. And I'll include a link to sign up for that in my follow-up email. So it'll be easy to access. In the chat, we heard that like, even though this particular business owner is not in the restaurant industry, like the case studies are really interesting. So we're glad that people are finding it helpful, even if it's super specific. You never know who else has that question, even if they don't know that they have it already. So
and Elizabeth, just to kind of build on that, understand you have quite a few good years ahead of you, and that's great. I do another series or webinar or two on selling a business and preparing to sell, and that's 5+ years out, can be. So I think it's on our YouTube channel, and we offer it periodically. So keep an eye out for that if that's of interest to you, and happy to kind of dig into that. That's a fun topic as well.
Yes, I am actually in the process of scheduling a I can't remember the name that we came up with, preparing a business for sale with Susan DeGrasse. So that's the beginning of June, and that will be live on our website soon as well. So if that's something that you're mulling over for the distant future, it wouldn't be a bad idea to check it out and just see what might go into something like that ahead of time. But she also mentioned, and I've heard this a couple times before, of like having sort of networking events that are industry specific, so that it could just be a bunch of restaurant owners talking about how to handle the potatoes, or
in the
workers,
The Women's Business Center does do cohorts
Yes.
of various industries, and that's one of our sister organizations at the SBA. So Elizabeth, that might be worth looking into. It's something we've considered, but we don't want to kind of offer the service twice. So we've mostly deferred to the Women's Business Center, but that is, they do a great job with that.
Awesome. Well, thank you all for joining. I think we're right at 1 o'clock. I'll send out that follow-up email later on with the recording and the slides and all of our upcoming events and our contact information. So you'll easily be able to click through to pretty much everything we've mentioned so far. And otherwise, we'll see you at the next one.